Hey everyone, welcome to the Trendline Investor channel. This video is going to be about swing trading. I'm going to teach you how to find stocks for swing trading using my own scanner. How do you define stop loss? How do you define the risk? How much should you buy? And also when should you be exiting? It's going to be a complete masterclass on swing trading. And this is going to be a very good video. Probably should watch it multiple times in order to understand because I'm going to cover a lot of points in this video. So let's get started. And remember one thing, in case you are new to the markets, this swing trading should not be the first point you start unless you have a good control on the understanding of markets. Now, there are a lot of other videos that I've done. So if you want to get started, start off with understanding what is demand supply, understanding support resistances, and then probably you should look at this swing trading video. So let's get started. First, I'm going to show you the scanner based on which how you can pick stocks. Now I have four dashboards. In this dashboard, I have four sets of scanners. One is CCI weekly crossing 100, basically where stocks are moving into a long-term uptrend from either a consolidation or from a downtrend. Okay, this second screener, which is CCI daily crossing 100. Now this is purely focused on finding stocks which are entering a short-term uptrend. Now the long-term uptrend can be up or down, but you might find both stocks here, but the short-term uptrend will definitely be up. So that's the kind of stocks that you'll be getting here, right? So I'll teach you what kind of setups you should be looking for. But the other two screeners here can be ignored. They are basic reversal setups. You could also try to find stocks from there. But if you just want to follow one screener, then this would be the screener that you have to focus on in order to find swing trades. So let's move on. So once you have all the stocks here, what you should basically be doing is you should download here. You should have a download icon when you hover on this, and then you download that and you import it to TradingView, right? So you can import it here to TradingView. Now this can be done in just a matter of 30 to 40 seconds, maximum a minute. I made a separate video on this. Learn to use my stock scanner. You just have to. It's a nice simple way to export all the stocks from there to TradingView so that you can quickly run through the charts and you can analyze the stocks. Okay, now once you've done that, then you have to add three indicators. Okay, now one is my favorite CCI indicator. If you do not understand what's CCI or Commodity Channel Index Indicator, do watch my video on my channel. There's a nice video explaining what CCI is. Okay, the second indicator that you have to add is the relative strength indicator, which basically tells you if the stock is outperforming the markets or underperforming the markets. So basically, I've done again another video on relative strength. You can check that out and you can add this as well as an indicator. The third one is basically volumes, which will help us understand whether it's big money coming in, how many shares are being bought, and all of that, right? Now CCI in TradingView, you can find this indicator. Just search Commodity Channel Index in TradingView, and you need to add Commodity Channel Index, which comes under Technicals tab, right? So I've already added it to my favorites, and that's why it's showing here. Otherwise, you should find it here. The relative strength indicator, you just search for relative strength Mansfield RS and add this one, which has 697 likes at this point. I'm recording this video in April. It might have higher likes going forward, but you just need to find this indicator and add it to your add it to your trading view. Right now, once you've added these three indicators, this is how your chart would look. And basically you will see the volumes here, the CCI is here, and relative strength is here. Now in CCI, I use 34 as the period. You can use what you want, it's up to you, but 34 basically looks at last 34 days, or basically last 2 months of trading, and that's why it looks at the trend of the last 2 months, how the prices have moved, and depending on that, the CCI would plot its value, right? So that's how your chart should look. If it doesn't look like this, DM me on Twitter, I can help you. Now, this is the most important slide that I have today, right? Now, there are 7 rules that you have to follow, right? It's very important to have a set of rules. Just don't go randomly buy any stock. These 7 rules will definitely help you spot really good opportunities. Now, the first rule is the price must be in an uptrend, or at least must be near to starting an uptrend on the weekly charts. Now, what do I mean by that? Now, in this stock, which I have here, Dharmaj Crop Guard, this stock has been in a very long-term downtrend, right? Now, this is a daily chart, but on the weekly charts also you'll have a similar pattern. Now, if you're a beginner, if you want to really understand if a stock is in an uptrend, all I have to do is see if CCI is above 100 on the daily charts and on the weekly charts. And if it is above 100, then probably the stock is in an uptrend. But you can probably use pivots also. Pivots will basically plot points here. You can search for pivot points high, low in TradingView, and basically you'll have some numbers, and the price should be above the previous pivot point, which is basically here, right? So, and then if the price is above that, then the trend is up on the daily charts, or if you're looking at the weekly charts, the trend is up on the weekly charts. Now, you can be a little lenient here. The price must be an uptrend in the daily chart. weekly, it's up to you, but I prefer having the price in an uptrend on both weekly and in the daily charts. So that's the rule number one. Now, rule number two, CCI should be above 100 on the daily charts. Now, on the weekly, however, it can be, but on the daily, CCI needs to be above 100. Now, this is a very important rule because reason why I'm saying this is I'm looking at basically a stock which has momentum, right? Where the price is in a momentum, and by momentum I mean it's moving fast, and that move will probably give us some returns, and that's what we're expecting. Now, basically, if you see here, when CCI was not above 100, the stock has been consolidating or probably in a downtrend, right? So we want to avoid such stocks. That's the rule number two. Rule number three is relative strength on the daily chart must be above the green line. Now, this green line over here is nothing but the last 52 days average. Now, I usually use this on weekly charts, but you can use it on the daily charts as well. I'm basically looking at last 52 days moving average, and the relative strength should be above the last 52 days, above the green line, which is the last 52 days of the price action, right? So that is the third rule. The black line should be above the green line to keep it simple. The fourth rule is the consolidation. Now, by consolidation, I mean that stock has to be going sideways or has to be in a downtrend for quite some time. Now, here I'm using a minimum rule for 3 months, right? Now, if you're buying a stock for swing trading, it has to come out of a 3-month downtrend or a 3-month consolidation, right? Now, higher the better. If you have 6 months consolidation, probably the move will be much bigger. Basically, the rule is the longer the consolidation, the higher the price would move, right? That's the assumption in technical analysis. That's the fourth rule. The fifth rule is the price should at least form some tightness in the last few weeks or so, right? In this case, if you see last 2 weeks, we had some very tight consolidation here, especially last 3 days here. We had some very nice tight consolidation inside bars, and then we had a massive move up, right? So basically, when price is contracting, by contraction, I mean, something going like this, right? And then you have an expansion. Now, any stock will go into a period of contraction and expansion. By contraction, this is contraction. And then you have an expansion. Expansion is when the stock moves fast, right? So it moves fast downwards or upwards. Now, here we had a move up, and then we had nice consolidation or contraction, and now price is again moving wider, right? So which means price is expanding. So we want contraction at least of few days. If it's few weeks, it's excellent, right? So that's the fifth rule. The sixth rule is price must be crossing the previous pivot high, right? Now that's also similar to uptrend, but here I'm making this a very specific rule. Now you should be able to identify pivots. Pivots are very, very important. Pivots are nothing but the highest point of the stock when a swing is made, right? Now this is a swing here. Now this is the highest point and this is the lowest point in this entire swing. So that becomes a pivot point. Now if you have problems in identifying pivot, just use the pivot points, high-low indicator in TradingView, and use the 10, 10, 10, 10 settings in daily charts. If you're on weekly, then you have to use 5, 5, 5, 5, right? That's how you should be using the pivot points indicator in daily and weekly. Now, the sixth rule basically says that the price has to cross the previous pivot, which was here in this case. Now, in this case, we have the pivot here. Price tried to cross, but it did not close. But here, it finally went above and closed above this pivot point. So that's the sixth rule. Now, in case price has not closed above the pivot, it's totally fine. Even if it was something like this, it's fine, but you need to buy above the pivot point. You should not be buying before that. Okay, so that's the sixth rule. The last rule is with volumes. Now, volumes need to be slightly above average at least. Now, in this case, we had a slightly above average volumes compared to the last couple of weeks. Right now, after that big volume day, now we had a very good volume day. So if it's something like slightly above this point is what I'm expecting. It doesn't have to be so high, but slightly above average of the last few days or weeks. Okay, a slight increase is good. If it's very good volumes, then it's excellent to be in that stock, right? So these are the 7 rules that you need to follow before picking a stock for swing trading. Okay, now let's move on. Now this is also very important. This is the risk management part. Basically, how do you define a stop loss? How do you define what risk you should be taking and what should be your targets? These are very, very important rules. The first thing is how do you define a stop loss? A stop loss, usually, I'm taking this example over here. Now, let's say you're buying the stock around this point, right? You're basically saying you want to buy, you saw this day here, and then you want to probably buy it here. Now, rules don't satisfy here, so I'm not not telling you should buy here, but I'm just taking example to define stop loss. Now, if you're buying the stock here, then your stop loss should be somewhere around that point over there. Now, it's the swing low. So we had a move up, down, and then we are going one way up, right? So stop loss should be here. Now, if you're buying the point here, then your stop loss should be somewhere over here. So the stop loss should be at a swing low here or at the breakout candle low. You could define both, right? So you either keep it at breakout candle low or you keep it at the swing low here. Now in this case, I've kept it at the swing low, which is the lowest point of the last 4 candles, right? Now you need to find a very reliable stop loss method in order to keep it doing consistently. I always prefer swing lows. Now in this case, here is where I would keep the stop loss. Now that's how you define a stop loss, right? The next thing is, what should be the stop loss percentage? Now the stop loss must be below 7% and not beyond that. Now remember, in swing trades, you're aiming for around 20% returns, which might come in a few days and then you exit, right? Now if you're getting 20%, at least you need to have, if you're taking 1% risk, you need to have one-time risk, then you're taking at least 3 times reward. Now in this case, stop loss is 7%. Anything below 7% is what you have to prefer. Now if it is 7%, then you can look for at least 3 times the risk, which is 20%. If your stop loss is 5%, you can look for at least 4 times the risk, which could be even 20%. If you have a 2% stop loss, then it could be a very good trade, because with the 2% stop loss, you can go up to even 20%, because in short term, you can expect stocks to go up to 20%, right? So if the stop loss is below 7%, ignore the stock and move on. Okay, do not, for swing trading, don't take anything beyond 7%. Okay, unless you're really good at managing your risk. The third point is, what are the risks that you should take? Now, what do I mean by risk? Now, if you have a capital of 1 lakh, then how much do you want to lose out of that 1 lakh when you're buying a stock? Now, in this case, let's say I'm buying, that much stock here, and let's say I'm buying at this point. Let's say take random numbers, right? So let's say I'm buying the stock at 100, and the stop loss is, let's say, 90. Now you have a 10-point stop loss here, right? Now, if you buy your entire 1 lakh, and if the stock goes from 100 to 90, you will lose 10% of your capital. Right? Now that is not acceptable. You cannot lose 10% just one trade. Now the maximum that you can lose is somewhere between 0.5 to 1%. Right? Now I say in good markets, you should not be losing, or you should be not risking more than 0.5% to 1% of your capital, which means if you have a 1 lakh capital, 1 lakh portfolio, then you should not be losing more than 1,000 rupees in a good market. By good market, I mean you should see many stocks moving up. That's a good market. If many stocks are moving down, then it's a bad market. It's simple as that. Also, if your portfolio is moving up, it can be a simple rule. If your portfolio is moving up, it's a good market. If your portfolio is moving down, then it's a bad market. It's simple as that. Right now here, if you have 1 lakh capital, 1 lakh portfolio, then do not risk more than 1,000 rupees. Right? Now that should be the maximum risk you take in a swing trade, because swing trades are very frequent and you can easily lose money if you have some bad trades. Okay, so that's the number one rule in the entire video that I'm discussing here. In bad markets, you should reduce the risk even further, because you might have more frequent losses. So you need to control your losses, and you can risk anywhere between 0.25% to 0.5% of your capital. Right? You take a small position, see if it works, and then if it works, then you can add more. Okay, so that's the rule. The next point is, what should be a position size? Now, what do I mean by position size? If you buy a stock, how much of that stock should you buy in your entire portfolio? Now, the rule here is, do not buy more than 25%. So if you have 1 lakh portfolio, do not buy more than 25,000 of that stock. Now, ideally, you should not, when you take, let's say you have 1 lakh portfolio and you buy 25,000 of a stock, and the stock goes down, you should not lose more than 1,000 rupees, which is 1% of overall capital, right? Now, it's very, very important to understand this. Rewind this video and try to understand this entire section again. Otherwise, you will lose money very quickly if you have a bigger position size. If you have 50% and the stock goes down 10%, then you're going to lose 5% of your entire capital, right? But if you have a 25% capital and if the stock goes down 10%, you lose only 2.5%, right? But here, you should not lose more than 1%, right? So which means you have to plan your trades accordingly. The last thing is targets. Obviously, we all want to know what targets. That's the most famous question on social media whenever someone posts a stock. So targets is, if you have a stop loss of 7%, then you should be looking at least twice the risk that you're taking. So twice the risk is 14%, right? So if you're trading with a 7% stop, then the targets you can look for is 14%, right? That's the first target you should be looking at. But once you reach 14%, then you should book 50% there, right? Because with swing trades, markets can be sometimes very violent. You might give back some profits. So at least book 50% of profits and keep it safe, right? Then the remaining 50%, you can book when the stock goes up 21%, because the stock is 7%, you can book at 21%, which is our ideal expectation when a stock moves, right? So 3x the risk, 7% stop, 21% you book the entire amount, entire capital, entire position you have, and you come out and be risk-free, right? Now, in some cases, some stocks tend to move even higher, and if you are able to ride the trend, you should be really an expert. And then you can trail the remaining position, 50% that you have, with a swing low on the hourly candle, and then you ride the trend as much as possible. Okay, so these are the most 5 important things in the risk management. Let's take some examples and see how we do swing trading. I also have two live examples which I covered in the last Sunday video, so I'm going to also discuss that, and probably you can learn much more. So in this case, I've taken Philip Carbon Black. Now, first rule is CCI needs to cross 100. CCI crossed 100 at this point here, and we had also a nice base here, nice trade action here. The stock has been going sideways for some time, so you buy the stock at the end of the day is also fine, or if you can buy even during the day is also fine, but I prefer you buy at the end of the day if you're a beginner, right? So you had a strong green candle over here. We had a beautiful correction. The stock had a strong green candle, a nice sideways consolidation. So you know that this is a very, very strong support zone, and you know volumes also are coming in, so you buy the stock on this day, right? Now here, if you see in this case, I have a stop loss of 6.29%. I'll move my mouse here for you to see, but this red point basically says the risk that you're taking. Now here, when I buy the stock at this point, I'm going to keep a stop loss at that point, which is the breakout candle low or the swing low as well, right? And then you're going to look at for targets of 2 times risk, which is the first target. Now 2 times risk here is at this point. So here you can just use this. I'll probably make a separate video of how to use this tool, but then you book profits around this point because you see the candle size is becoming smaller and smaller, and then you book 50% here, whatever it is, book 50% when you reach 2 times the target. And then as soon as stock reaches this, the remaining position 50% that you have, keep it to cost, right? Now do not lose money on the remaining 50%. So move your stop loss to cost. Basically the price that you bought, if the stock goes to the price, exit, right? That's simple, right? But then the stock kind of came down and then it went again higher. So then what you could do is trail your stop loss here, and then once the stock reaches 3 times the risk, then you exit, right? Now also some other rules. So volumes have been good. We had a good strong green candle. We had relative strength also here, pretty good. CCA also is pretty good. So that's all somehow you can buy. That's one of the ways you can buy. Now you might question, why can't I buy here, right? So you could have also bought here, but on this day the stock moved up 10% already. So if you were really observant in the markets, then you could have bought the stock around that point. The stop loss are that low, but it's completely up to you how you trade. I really don't have any preference. I prefer stop losses which are low. It's up to you to develop a preference for your trading style. Okay, so that's the first example where we almost had a 2x reward, right? Now next example is Alchem Labs. Now again, if you notice in both examples, I'm looking for tight consolidations, and then the stock needs to come above CCA 100. Now the stock came above CCA 100 at this point over here, and the stock prior to that never came over CCA 100. Now when you have such tight consolidations, the chances of you making a profitable trade is much higher. Also volumes have been slightly above average. We had a similar volume to this point at this point, and then the stock kind of, you have to first calculate the stop loss. The stop loss here is 2.94%, which is very good. And then here the stock went up almost 6% here. You could have booked profits around this zone, or you could have trailed the stop loss if you think the stock would have gone much higher. But definitely you should have got out at this point because we had multiple wicks and the swing low was broken here. So definitely you should have gotten out at this point, right? And then probably entered here again. Now swing trades, you can also follow over just one stock, or keep looking at the stocks that you traded, because swing trades you can get multiple opportunities. So it sometimes makes sense to just keep looking at the stocks that you exited so that you can get again new entries, especially in places like this, right? Because this stock was consolidating for a long time. And here the most important point here is relative strength. Relative strength has been very good. So any dips could have been bought as well from a position trading perspective as well. So let's keep that aside. Now I'll give you two examples which I covered in last Sunday video. I'm not sure how much they moved here, but these are two stocks. First is, I covered 6 stocks, and I'm going to discuss just 2 stocks here. One is J Kumar. Again here, CCI crossed 100 after a long time. And if you see here, we had this nice downtrend breakout, a nice sideways consolidation here, and the last 2 days, good candles and good volumes. And later strength also is crossing above the green line over here. So this could have been a very good buy. I'm not sure today at what level it is, but 266 could have been a very good buy with the stop loss at 248 over here, which is 6.7 times stop loss, right? 6.7% stop loss. And you could have booked probably a 2x or 3x, however, depending on your style. Another example I covered was BLS International. Again, a beautiful trend line breakout, a very nice tech consolidation. And then we had this CCI crossing 100, data strength above the green line, and a good volume. And this could also be a very good trade from a swing trading perspective. Now, if you liked all this analysis or how I taught you swing trading, don't forget to subscribe and like my video as well. And do me a favor by sharing this video with your friends and family and help them learn swing trading as well. I'm going to leave you here. I'll see you in another video. Until then, take care, stay safe, and trade safe. Bye-bye.